Welcome. This is Will Allen and Michael Brooks here. This is the day after Fed Day. And so we thought we would have a conversation and talk about what the Fed did yesterday. Also kind of an updated look at inflation and interest rates and how everything is impacting markets. So Michael, the first thing I guess we could say is yesterday they hiked interest rates by 0.75%.
Yes, which was a little bit of what the markets had really anticipated was pretty expected since we got some updated numbers a week ago.
Yeah, and so, at the last Fed meeting, Powell was asked if 0.75 was on the table for this meeting. And he said no.
That's right.
And a lot of people thought, hey, why did he take that off the table? On Monday, and to your point, last Friday, when that 8.6% CPI came in, along with the University of Michigan consumer sentiment at 50, its lowest level on record, and inflation expectations jumping to over 5%. That's consumers saying we think inflation, and that was a major move higher, and that is what has worried the heck out of the Fed. They don't want inflation expectations getting high. So on Monday afternoon, the Wall Street Journal, a reporter named Nick Teramos, who is tight with the Fed, he came out and wrote an article basically saying 75's on the table, which was really the Fed saying that's what we're doing.
Yeah, well, this thing seems to be adjusting every other minute right now. And here's the thing, and I get what they're trying to do, which is thread this a little bit of a needle here, which is, and here's the big question I think that applies to how we're managing money, what we're doing for folks is, I think the biggest question out there right now is inflation worse or is a recession worse? And I think that from what we've seen, the Fed absolutely believes inflation is worse than a recession. Would you have that take too?
Yeah, I think a couple things come to mind. Number one, what kind of recession we're talking about. What people have in their memories now is 2008. That was a financial crisis. That was a deep recession.
Yeah, a beyond a normal recession.
Exactly.
It was the biggest drop we've had since the Great Depression.
Yeah.
In modern history is the worst crisis, and then S&P was down 57% from top to bottom.
Yeah,
right?
And you had banks failing, and that was really, really bad.
As soon as we were launching our careers in finance,
yes,
right?
Exactly.
right.
So something like that, but that's not always the case. A lot of recessions are more milder. And so, I think what the Fed is saying now, and look, I think it says a lot that consumer sentiment is at the lowest level ever. It's lower than it was in 2008. It's lower in March 2020 when COVID hit.
Okay, let's make sure we understand.
Yeah.
Consumer sentiment means...
How
do you feel about the market,
yes.
right?
Well, the Michigan survey isn't really about the market. It's how do you feel about your current life as it relates to the economy is really what it means.
Right.
And, and so I think, and it's not just that. Take a look at political polls. You're talking about, and this doesn't have anything to do with policies, but like Joe Biden, as inflation's gone up, his approval rating is the inverse. Like the bottom line is that the fact that people are having to pay so much, gasoline's number one.
Obviously.
Food.
Because we see gas every single time we go to the pump.
Exactly.
Every single time we're driving to work, we
Yep.
see the flashing of those horrifying numbers compared to where we were a year ago.
Yeah, and every time you fill up and you see, hey, this is double or triple what it was, I mean, it's like a stabbing to the heart.
Yeah.
And then it's happening in food, it's happening in housing, I mean, it's happening everywhere. Airfares are up 40% over last year. I mean, everything's higher, and it's clear that across the board that people are saying, make it stop. And again, to illustrate the point of that, Biden has said multiple times, I'm giving the blessing to the Fed to majorly hike rates. What he's saying is, I'll take a recession over inflation staying this bad.
Yes, I
That's
think
what
so
he's
too.
saying.
Yeah.
And Powell's saying that. And so I think that a recession is, if that's what's necessary. And look, 2-3 months ago, I think that most people thought a recession still wasn't that likely. And what I would say, even now, the bottom line is consumers, and this is what's so interesting about things being so dire in consumer sentiment.
Right.
Consumers are still looking at how much cash they own hand, their job situation.
Right.
Anybody can get a job.
And there's pressure. There's competition for higher wages.
Yeah.
They're making more money than they ever
Yeah.
did before. I think before the pandemic, the only labor weirdness is that participation rate, which we saw drop off, and I think will take a while.
Yeah, I mean, there's obviously a lot of people. Well, there's 1.5 million who haven't come back into the labor force, and what's interesting is women have come back faster. It wasn't that way really early on, but women have come back faster. There's a lot of men aged 25 to 64 who haven't come back yet, which is a little weird. Women, if they got kids that they're at home with, early in the recovery, women lagged because women stay home with the kids if they're not at school, etc., more than men.
Yeah.
But then that has flipped in the last 9 months. But yeah, a lot of that group is going to come back. Look, if we do get some kind of a mild recession, and I think, look, so far, there is nothing that we've heard from companies, and there's nothing looking at consumer that would indicate a 2008 type recession.
Oh yeah.
Is likely.
Right. I mean, that was an unheard of event at the time. We're in a completely different place now than we were then when we talk about capitalization of banks, and the consumer is much better off. We haven't seen a lot of these ridiculous kinds of margins and calls on like kind of the market breakdown.
Yes.
That we saw, especially in September, October of 2008,
Yep.
when everything really, there was a time there, bonds ended up finishing up for the year,
Yeah.
I believe, but
Yeah.
for a time there, they were down a big 10 to 15% intra-year to date. So even conservative investors were thinking, this is doomed here. We came out. How long did it take for recovery? From 2009 March 5th, right? Was the bottom, and then we got back to even levels. I think
Yeah.
it was 2012, if I believe.
Yeah,
is correct. It
let's
took
see.
like
Let's-
2 years.
Yeah, it may have been a little bit longer, but it was. Yeah, you're not too far off. Let me
Yeah.
just look for sure here. Yeah, it was 2013.
Okay, so that was the worst crisis we ever had, and it
Yeah.
recovered within 2
Yeah,
years.
in our time. I mean, obviously for a month, COVID was worse just because the economy came to a stop, but it was a V bottom for the markets.
Right,
I mean,
right.
a few months later, it had made back a lot of its losses,
Right.
So, yeah, 2008-9 was a lot deeper. And obviously, there are people who want to, or don't want to, but ask, hey, look, we've seen crazy stuff in housing, crazy appreciation, especially in the last couple of years. We saw a lot of that in 2005, 6, 7.
Right.
What was really different back then is that there were so many subprime mortgages. People could get loans without even showing their income documents. You could go out and get $1 million mortgage if you made $60,000 a year. You have people with 550 credit scores getting mortgages with no down payments.
My favorite scene from The Big Short,
Yes.
as he walks into the adult entertainment
Yeah.
area,
Yeah.
and he starts having a conversation
Yep.
with the woman there who had
Who
just
has
bought
multiple houses in Miami.
in Miami.
Yes. Yeah, exactly.
I mean,
exactly.
come
And
on.
he comes out and says short everything.
Right.
Yeah, that really illustrates the point. And you had 12 months of inventory going into that crisis. And so the minute demand started to dry up, prices plummeted. It's just supply demand. Today we have 2 months. And obviously, look, housing is slowing finally. The Fed wants it to happen. The Fed's seen the bond market get crushed. It's the worst year to date the bond market's had in its history.
Right.
I mean, as of right now, the Barclays Aggregate Bond Index, which is the S&P or the Dow of the bond market, is year to date down 13%. The LQD, which is investment grade corporate bonds, so Walmart, Coca-Cola, Apple, your high quality companies, not companies that there's significance of default, is down 18% year to date. And long-term U.S. Treasuries, TLT, 20-year plus U.S. government Treasury bonds,
Which is long.
down
Very long.
26% year to date.
Right.
Those are major losses. So you've seen bonds down big. You've seen stocks get hit hard. Crypto has just blown up, which that's a whole different thing.
That's a whole different ball of wax
Yes.
that we need to unpack at some future date for sure.
But housing is going to slow. The Fed wants it to slow.
We want it to slow.
We want it to slow.
I
It's
think
not
so.
It's not healthy for anybody.
No.
And we've today, housing starts, and housing permits. What builders or how many homes have they started and getting permits? So future starts. We're down 14% versus an expectation of down 2%. Last week, and I emailed this out in a blog post on Monday, mortgage demand fell the largest fall and to the lowest level in 22 years since the dot-com era. Mortgage is a 30-year mortgage was at 3% 6 months ago.
Yep.
Today, it's at 6.35, man. This continues on. It's going to be over 7% here in the not-so-distant future. It never got anywhere close to 7% in the recovery from the financial crisis. We haven't seen these kind of rates since before the financial crisis.
And the Fed funds rate was up to before, we're talking about mid-2019.
2.5.
Yeah.
2.5 was its cycle high.
I mean, higher than it is now.
Yeah.
So why do you think that mortgage rates have jumped up that much compared to where the fund? I mean, do you think that they're expecting a longer term rate problem, or that's what's been curious to me is why rates have been kind of uncoupled a little bit from the current Fed funds rate. I think they're maybe looking more out to the end of the year, maybe beginning of next year. Is that kind of where you see things too?
Yeah, you got a couple things. You have the 10-year Treasury, the mortgage rates follow that pretty darn closely, and even more so than the Fed funds rate. And so the incredible increase in yield we've seen in the 10-year is one piece of it. But another piece of it is that mortgage-backed securities, again, were ground zero in 2008 and 9 because you had huge levered bets. And the way to explain that is this. Let's say there were examples in the dot-com or in the financial crisis where an investor could say, I have $1 million of my own money. I'm going to Goldman Sachs and I'm going to try to borrow $2 million. And I'm going to go to JP Morgan and borrow another $2 million. And I'm going to go around. And I end up with $40 million. Okay? And some people were able to achieve this. And I'm going to bet on mortgage-backed securities. And if my $40 million, if mortgage-backed bonds drop 10%, I've lost $10 million. I only have $1 million of my own money.
Right. Where are you going to get the $9 million from?
And so those are losses for these firms. And that's exactly what happened in 2008. There were a lot of majorly levered bets.
Right.
Okay, now, that did not happen to that degree this time. But I think that there are people who are still a little nervous. And we also know that the Fed, starting this month, quantitative tightening. Part of that is, and this was the insanity of last year.
Right.
We talked about this.
Yes.
They were continuing to buy $40 billion a month of mortgage-backed securities, subsidizing housing, even though housing prices are on fire.
Right.
They kept putting the money in the system. Maybe the worst decision of any of these decisions.
Well, what I found funny was Powell's comment yesterday about how we're just going to be following the data and we're going to react to the data.
Yes.
Well, where was that attitude a year ago? You weren't following the data because you thought that this was and I get it. Look, can we talk a little bit about the supply side of things too?
Yeah.
Because we know that on the demand side, there's obviously reopening of COVID.
Yep.
There's the gas oil issues with Russia, Ukraine,
Yeah.
plus
Yeah.
the opening of people going back to vacations and things like that. So there's that side of the demand, but there's also the supply side, which we've heard a lot of, and we heard a lot of Powell's comments. We've heard a lot from the White House administration about the supply side needing to come around to fix some of these problems. And one thing I will say that Powell made a very, very he talked about this quite a few times, I felt, and he was pretty strong about it, was the fact that, hey, we can't do anything about oil and food. So,
which is true.
Which is true. However, I did think it was interesting to see how much oil has fallen since in the last week or so. But still, given that he can't try,
Pull up on your chart here, and we'll put it up for the folks at home to see. Go under Y charts, and in the search function, type in US M2 money supply YOY year over year.
Ah, yes.
And do max on this. And I think the point here is that you're exactly right that he can't control. I mean, look, there is some impact just because if money is flowing everywhere, okay, it's just it invited more and more speculation, and that just goes into everything, okay? And so everything goes up. So there's a little of that.
Right.
But when I put this chart in my update on Monday. I mean, look, that tells you all you need to know, man.
Yes, it does.
And look, early in 2020, when Congress got together bipartisan and passed a couple $1 trillion spending, and the Fed, all of that was necessary. The economy literally had ground to a complete halt.
Yes.
And GDP had gone off a cliff, and you had to put money in the system, no doubt about it. But you can look at this and say, okay, the punch bowl stayed out too long. Some of the later bills that were passed were too big in Congress, and the Fed printing $120 billion and keeping rates at zero and buying mortgages, it just went on. This is too much stimulus here. You're talking about 25% growth when we had never had more than 12. And look, when was the last time? The only time we've had 12 in the history was in the 70s. And what was the 70s? Our worst period of inflation ever. You look in the 90s, much prosperity with Bill Clinton, and you had George W. Look at money growth. It was low, and then even in the 2000s and the teens, when you had some pretty good times happening, you didn't have any inflation issues.
Right.
So early on, no doubt, you had to bring a bazooka, but this to me is the chart that just illustrates, and Powell last year was asked about this in his press conferences, and he was really responsible here. Hey, look, it seems we have excess money in the system here. Inflation's coming up.
Right.
And, it hit 5 last May. And you can go back and look at his press conference. And Janet Yellen in the Treasury said the same thing at the time. We're not worried about this. This is transitory. By the end of the year, it's going to be down. And one of my concerns yesterday, here's the good news. The good news is that the Fed significantly increased their projections. We were just talking about it. They were at 1.9. Why don't you recap that? They were at 1.9% by the end of this year at the last meeting.
That's right. Yes, that's right. And now we're at, where do they
3.2.
3.2?
3.3.
And then they're saying about 3.8 by the end of 2023, right?
Yeah.
So it kind of levels off next year, right?
That's more in line with where the market is.
Yeah.
Okay, so that's positive.
Yes.
But there's one thing that I think they're still way off on. They have inflation by the end of 2023, so a year and a half from now, at 2.6%. 2.6. Okay.
So that's a 6% reduction in inflation from now until next year. Right.
Okay, let's put some context. 6 months ago, they said inflation this year was going to be 2.4.
Okay.
So the 2.4, and right now we're at 8.6. So they a
little off.
They're way off. Okay.
Okay.
Now they're
no, that was before Ukraine
Yes.
Right?
Yes.
Before Ukraine. So we do
Exactly.
know that there's some things.
And exactly.
in there.
And absolutely, that certainly has poured more gasoline on the fire, no doubt. But inflation was 7 at the beginning of January before invasion happened. So it was going to be higher than the Fed projected by a wide margin. Anyway,
right.
That just made it even worse, the Russia thing. And not just that, the China COVID lockdowns,
Yes.
which to the supply chain is a crusher.
Which they just opened Shanghai June 1st.
Just started
We're talking 2
slowly
weeks
opening.
ago. So some of the supply
Yeah.
thing, we might see August numbers?
Yeah.
Probably,
Hopefully.
maybe.
Yeah.
But
Hopefully.
I mean, we
Yeah.
get through the summer, we
Yeah.
get some more, because now we're in we have 6 weeks until the next big kind of announcement comes out almost. I mean, we're in a lull period here for a number of weeks until, I think we got it some time.
Exactly. And so the next couple weeks, you're going to have the Fed voting members, because they were in a quiet period other than their leak to the Wall Street Journal to say, get it out there that we're doing 75. But we'll have interviews where they'll start talking a little bit, and they've been following the market. I mean, the 2-year has made the Fed's decisions for them and forced the Fed to pull along. And so here's the thing. This is the bottom line for the markets here. Let me throw this out there and see what you think.
Okay.
I'm of the belief, and we have not been overly aggressive this year. We have not. Neither one of us have gone in and significantly done buying here. In fact, we've if anything gotten a little more conservative. I know I went in, for example, in mid-March and then again in mid-May and got more conservative. Things have still been ugly for the markets, but to me, the next 6 weeks is about 2 things. Number one, interest rate. I mean, obviously inflation, of course, but interest rates, meaning the bond market has to stabilize. We come in every morning. I wake up at 6:30, and I look at my phone, and I look at interest rates the first thing I do.
Great way to wake up in the
Exactly.
morning. I mean, don't you all wake up in the
Exactly.
morning and look at interest rates
Yeah.
first thing?
It's a little more interesting in 2011, the summer of 2011, when you had kind of the European crisis of Greece. You remember this, the sovereign debt crisis.
Yes.
Yields in Italy and Spain spiked to about 8%, and our markets here dropped about 20% in 3 weeks, okay? And you'd know what stocks were going to do based on if yields were skyrocketing, thus bonds selling off in Italy and Spain and France, you knew stocks were going to be down. Well, the same thing's the case now. If we wake up and a 2-year treasury is jumped from 2.85 to 3 overnight, stocks are going to be down big. And to put things in context for folks, normally the bond market's very sleepy. It's going from 285 to 287. That's a big day for it.
Right.
And these are very unnatural moves, and these are bonds selling off, yields going up. And to me, you've got to have bonds stabilize. And again, rates, if the Fed is trying to play catch up with their hikes, right?
Yeah.
After yesterday, they're at 1.5 to 1.75 for their federal rates. But a lot of rates are already there. Hence, mortgages are at 6.3.
Yep.
They're up 3%. So a lot of these are adjusting in real time and have been for a while. I think we need to see rates stabilize. I think as long as people are saying, hey, my bond portfolio keeps losing a lot of money, how can you feel comfortable about stocks if your bond portfolio are having those kind of losses?
Which is much more stable of a market in most normal times. Right?
Yes.
Yeah. So, okay. So if we start to see some changes in the bond market where we see the treasury rates kind of either stabilizing or coming back down a little bit, that'll be a very positive sign for markets. If we have some data on where do we look for data on supply chain issues? That's one of that's a hard one to find. And can we get a little bit ahead of just to see a little bit of some trends going into some positive directions there, where we get some more supply coming through?
So the main thing on the supply chain, really, there isn't as hard a data there because it's tougher to get specific. The main thing there are company conference calls, because they pretty much, when they release their earnings reports, and have been some sporadic reports in June. There are some companies who aren't on cycle, but most earnings come out the first month of the quarter, about midway. So mid-July to mid-August will be 90% of the companies in the S&P 500, okay? That's when you'll hear from companies, because these CEOs and CFOs have been the ones for a year and a half saying on calls, our supply chains are in shambles.
Right.
And we started in April and May, we started to get some movement there, where you had some companies saying, hey, things are starting to improve a little bit. Whereas we had none of that for a long time. So we saw a little movement, you know what I mean?
Yep.
So that's a great point you make. That's when we're going to have that. And let's mention, so rates, supply chain, and critical. I think the other critical thing is right now, what's a big head scratcher is you can go to Ed Yardeni. He's an advisor, but he's known for his data. You can go to Ed Yardeni's site, and he has a chart, a lot of charts, but one that takes the aggregate of revenue projections and earnings projections for the S&P 500. As of right now, there have been no cuts made for companies for this year. Earnings per share for the S&P 500 is projected to grow at 9%. There are some analysts who think that earnings are going to end up growing nowhere near 9%. A few even think earnings are going to decline. If analysts start cutting earnings,
forecast
of where they think companies are going to be. And there's a couple ways they can get there. They can look at their data. They also can get there by companies coming out. For example, Microsoft came out 3 weeks ago and said, we're going to miss our earnings estimate for this quarter. There's a little asterisk there. Their reason was because of the dollar. And a lot of S&P companies are going to have this problem. That the dollar has strengthened. It's at 20-year highs.
Yeah.
40% of the revenues for the S&P 500 come from overseas. When the dollar's that strong, when they convert it back into dollars, it's a decline. So a strong dollar hurts their numbers. So you're going to have some cuts there. That's not what worries analysts that much. They're more concerned, do we start seeing your well-run companies coming out and saying, hey, we've seen a deterioration in demand for our products or services, we need to cut guidance. And so then these analysts go and they say, okay, we had Apple, at this number, it's now down here.
Yeah.
Because if you start to have earnings cuts, a little bit's okay, but you start having a lot of cuts, and we're going to hear from companies here next month.
Yep.
Hey, with your supply chain issues and all the other things you're dealing with, China in lockdown is a problem, because Nike and Apple and Starbucks and Caterpillar and a lot of companies are getting 10, 15, 20% of their revenue from there. Now, so far, they have not come out and say this is problematic, and you've had some companies come out and say, hey, we're still doing pretty good, even with the lockdowns there. But that's something we got to watch.
Yeah, I think so too. And any kind of solution to some of these supply chain issues, like, hey, I remember a couple of months ago, Intel said, hey, we're going to move, we're going to set up a factory in Ohio and try to do, that's just not in the card. That's not something we need to be waiting on.
Yeah.
That's going to take a long time.
Yeah.
The workforce over there, especially in Taiwan, by the way, we should talk about that at some point.
Oh, gosh.
The China-Taiwan issue. But
90%
of our semiconductors all in Taiwan. So that right there is another issue. But once we start, I think when we start seeing, we've had complaints from everybody from Tesla to, like you said, Microsoft and Apple have really, we can see that the expectations for how many products they're going to be shipping out and making and is a lot less than we had thought were going to happen from a year or so ago to now.
Yeah, so tell me what you think about this.
Yeah.
I think I would say that so far we've talked about some of the challenges out there, and we've talked about, the market activity year to date, and I think there's a lot of challenges, obviously, that goes without saying. the silver lining, if there is one, and I think there is that the market has priced in a lot of challenges. Okay, the bond market, stocks,
especially tech stocks.
yeah, especially tech, and the longer term outlook, like for tech, is still really, really good. One of the things this last quarter that was interesting is that if you listen to what companies had to say, it was really, really positive. Now, no doubt things are going to slow here. The Fed wants things to slow. We need prices to come down. We need demand to slow to get inflation under control. So we know that. But we're starting from such a really, really strong pace in just how well companies were executing, how strong company balance sheets were, outlooks were really good. So yes, supply chain issues were bothering companies. All the sky-high commodity prices are a problem, and a tight labor market's kind of a problem. But stocks have adjusted. Bonds have adjusted. All these asset classes have adjusted to say, hey, here are some challenges. And if you look out 2 years, 4 years, 6 years, let me take an area like cybersecurity. And that's a part of tech. But cybersecurity companies, demand's at the highest it's ever been.
Oh, absolutely.
And there's not going to be significant cuts in budgets to cybersecurity. That's not something companies can slack on. They have to have it.
Yeah.
Yet, a lot of the cybersecurity companies are down 40, 50%.
Yeah, and we were just talking about this before we started shooting, but one of the biggest weird things that has happened from COVID that I think is so interesting and very, I'm skeptical that this is not going to just turn around like a mega force when some of these things we're over some of this time period, is the fact that we act like nobody's going to be on the computer anymore. Like COVID happened, we were in our houses and our apartments, we were holed up for a year and a half watching Netflix and other things, and now that's it. We're all outside. We're only vacationing from here on out.
Yes.
So we are not going to be on our ridiculous.
Yeah.
I mean, I just think this has been a major overreaction to a very specific, the COVID bump, as we want to call it. I mean, yes, some of those stocks did really well, but you have a ton of stocks that are down a lot from before COVID.
Yes.
So that doesn't make any sense to me. I mean, I get that there are some pressures out there, but some of these have just been so negative that I can't help but think, give this a few months or so, maybe a year, and just watch. I mean, I just think some of these areas are going to take off like a rocket because they realize that, you can't punish these companies that are down 80% from their high when that's worse than they were before any of this COVID stuff happened, and much less the fact that the trajectory for any of these tech services are only going to go up, like you mentioned with cybersecurity, data centers. All this is ballooning and will keep going for the foreseeable future. This is the future of our economy. It's tech.
So to that, first of all, I agree 100% with you. And I would say that I'll give an example of that. I think it's important to look at how was the company doing pre-COVID. There are plenty of companies that were on fire that were before COVID even hit. And
we're not talking the Peloton bike or anything like that. No.
So let's take Amazon, something everybody knows.
Okay,
and
let's do that.
Amazon had e-commerce and they also had the cloud. And they were on fire. It was a great stock before COVID even hit. When COVID hit, that just accelerated business. They grew like crazy, okay? That stock is down now 47% from its high. I don't doubt that in the 3, 5, 10 years to come, they're still going to be a great business. They were that before COVID. COVID was not the kingmaker for them. They already were great.
Right.
Versus Peloton. The stock was at $20 pre-COVID. Their business skyrocketed. They went out and thought this is going to last forever, started building factories, building more products. Demand just plummeted. and it's back to where it was pre-COVID. And you know what the stock's done? It was at 20, it went to 160, it's now at 15. And I wouldn't touch it. Before COVID, they weren't some amazing, well-run business that was, had this amazing future.
Right.
They're back to what that now. COVID was a 1-year gift for them.
Yep.
Here's all this business you're going to get. But I don't know. I'll bet the stock never, ever gets back to 160. Similar to in the dot-com era, there were a lot of fly-by-night internet companies that went bankrupt or never recovered.
Webvan, baby.
Exactly.
Webvan,
Pets.com, and plenty of fiber optic companies.
Right.
So it was loaded with that. I think that's the same thing here. And I think what the market has done is they have thrown all of the COVID winners out.
Right.
Instead of saying, wait a minute here, a lot of these companies were doing great before COVID and are going to still be doing great in the years to come. Because to your point, we're not going to have everyone taking vacations every few weeks permanently. I mean, there was a huge demand for travel because people stopped traveling, but there is going to be demand for a lot of online e-commerce and transition to the internet and the cloud. I mean, all of that's going to continue.
Look, I mean, I bring this up frequently when I think of before COVID. I could maybe do, a Skype or a FaceTime here or there. I'm doing Zoom calls all the time.
Yep.
I mean, it got us used to certain ways of doing business and seeing family and friends. This is what tech does. It changes the way we live, and I just don't think that's going to just fall off because we have a couple of, plus it's 105 degrees next week here in Atlanta.
Yes.
I mean, we're going to want to be inside occasionally here and there. So I think that some of this is way overblown. Give us some. Let's finish with some more positive news as we kind of wrap things up, because we talked deep about the Fed. What he talked about last week, we talked about interest rates. We talked about some of the supply chain issues still ongoing, the money supply. There's a lot of technical data that we keep throwing out. But what do we think is some of the like you said, is some silver lining, but let's wrap it up and kind of where we see
all
the
right,
things.
So I think number one, the fact that the Fed, and they're still way behind, but doing 75 was a step up for Powell.
Yep.
Okay, so it's good that he at least did that. I'm hoping that the next month that we see the bond market start to calm due to the fact that the Fed's expectations and the market's expectations are more aligned. The bond market's been very volatile because there's been this big gap here, and I think that's been part of the problem. Not the whole problem, but part of the problem. So I think Powell and the Fed are getting more aggressive. That's good. The bond market and expectations getting more in line. And then I think just the fact that you have a lot of parts of the market now down 40, 50, 60% that are well-run companies in a lot of funds. And then for folks who own stocks directly, not that you go out and buy all these names now, but when you have Amazon down 45%, Netflix down 75%, Facebook 55%, Nike 40%, Starbucks 40%, and just go down the line.
Right.
The home builders are down 45%. The automakers are down 45%, Tesla 52%. The point is that these are businesses, these are not fly-by-night companies. These are, Disney's down 55%. Again, not to say all those are good investments, but to say any time in history you get those kind of losses to companies that have been around a while, that are, in most cases pretty well run. They're not all perfect, of course. You have to at least start to say, okay, if I look out a little ways, there's a really good chance that I'm going to make good money. And look, those are the names that are in most of the funds that people own, or the individual stocks.
They get the most weight.
Pick any index fund. I mean, those are the companies that are in there.
Yeah.
And so I think that you have to start to say, hey, look, the market is known for overshooting on the upside and downside, so you have to keep that in mind.
Yep.
But you start talking about valuations now have been reset. We were probably a little overvalued at the peak in November, plus rates were near zero. And there's been a lot of work done. We are now back to very, very reasonable valuations. So I think there's a lot of positive. And if in the back half of the year we can get any progress on inflation,
Yeah.
any progress on the bond market stabilizing, any progress in Russia, Ukraine, and any progress in China, hey, that'll be one more thing than we've had this year, because we've had nothing positive in any of those areas. Everything has gone against the markets.
Yeah.
And I'm just saying, at some point, some of those things are going to start to turn. And when they do, markets should react very strongly.
That's a great point. And just to piggyback on one thing that you mentioned, I thought of here was, we've seen this happen, especially in some of the big market down moves that we've seen over the last, decades that we've been doing investment management, is when you start to see some of these big names that have been the traditional momentum high flyers, exceedingly great growth, and you start to see those break down. That's usually a sign that it's not the fly by night smaller companies, but they're your big players that don't have really any major news to scare or spook markets, and you're seeing some of these big names down 40-50%. That's usually a good sign that this may be a little overdone and may be time to see some positive moves up. So I think that is encouraging. So well, let's wait through the summer. We got a lot of volatility still probably heading our way, just like we've had over the last 6 months or so. But I think, like you said, I'm looking forward to the second half of the year getting some semblance of good news.
Exactly.
I think it's really would be difficult to put even more heat onto this bad thing. So let's get some good news coming for the rest of the year.
Sounds good. Absolutely, man. And I hope y'all enjoyed it. And as always, we'll keep y'all updated, and have a good weekend.
Thanks.